In stock markets, when there is a 3 to 5% fall in a day, the newspapers would scream. There'll be bold headlines, market meltdown, investors lost so much wealth, and all sorts of adjectives would be visible on the newspapers. The television screens, the websites would be full of interesting stories. And of course, in the recent social media world, you will also may have a meme fest. But this is about 3 to 5% fall, which is by no means a small drop. Now imagine if the market crash is 20% or more in a single day. Unimaginable, isn't it? Well, but that happened. The date was 19th October 1987. It was a Monday and now popularly referred as the Black Monday. In a single day in the United States, Dow Jones Industrial Average fell by more than 22%. In a single day, the market capitalization of all the listed companies dropped by more than $500 billion. And we are talking about 1987. Massive. So what had happened actually is the story. This was an era where computers were getting deployed at a very early stage. But some traders had also figured out mechanism to do what we popularly know today as algorithmic trading, where some algorithm is written and that algorithm can trigger a trade or a transaction. In 1987, it is believed that the algorithm that was used is also called portfolio insurance. In the normal trading parlance, we may call it stop loss. So this stop loss gets triggered when the market levels or the script price moves beyond a particular level, either upwards or downwards, and the transaction gets triggered. Now, most of the times we are familiar with a dealer sitting in front of a computer and typing or punching the orders, and when the stop loss is triggered, the exchange automatically triggers that because that order is already punched in. What if the computers are doing this job and the computers are doing this job simultaneously for an extremely large number of investors? When one stop loss gets triggered, instead of 10,000 or 15,000 transactions which we may see today, you might see 10-15 lakhs or probably 1-2 crore transactions being triggered simultaneously. And when that happens, there's a cascading effect. Once that cascading effect happens, people who have bought or sold on margin may get margin calls from their brokers. Considering that a 5% event, 5% drop is a rare event, a 20% is almost unimaginable for most. And that's when people may or may not be ready with sufficient fund to pay the margin calls. And when they are unable to pay, the brokers have to square off the transactions, which further triggers the fall. It is believed that there was a portfolio insurance mechanism at that point in time. A large number of computers triggered that, and we saw massive crash happening. Now it's important to understand that this happened in 1987 and we haven't seen recurrence of such an event. And the focus of the story is to highlight what happened subsequently. The world over, the traders became smarter, the regulators became smarter. They came out with regulations, they came out with risk management systems, margining mechanisms, collateralized mechanisms, because of which an occurrence of such an event is highly unlikely. But at the same time, as they say, whatever is highly unlikely does not mean the probability is zero. As an investor, it's always better to be prepared for such an eventuality, and that means your portfolio needs to be diversified across various investments, and you set limits of exposure on various levels. So if you're a trader, be careful how much margin you want to take, how much do you want to trade, and what about the other part of the portfolio. If you are an investor, if you don't understand trading, don't really venture into this activity, which requires full-time attention and a little bit of expertise. If you are traders in stocks, don't venture into derivatives, because derivatives are anyway margin-based products. Learn about various such episodes in the history of financial markets. Make yourself a better investor. Wish you all the best.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.